All right, welcome back to another edition of Advanced Accounting. I want to go through a comprehensive example from your book, and I will post these lecture notes up on Blackboard, so when you're going through this video, you can fill this information in as you watch the video. So what have I set up here? Essentially, I have a general ledger, and the general ledger has various balance sheet accounts: cash, tax receivable, an allowance for tax receivable, another tax receivable, that's for delinquent taxes, an allowance for that one as well. A tax lien receivable, an allowance for that one as well. A due from the special revenue fund, and then we have accounts payable, fund balance unassigned, and fund balance assigned. This information is coming from your textbook information right here where they talk about the Ranford County. This is the comprehensive example. I'm taking all the balances from the balance sheet and I'm showing them here. Debits look like positives and credits look like negatives. We're going to go ahead and just abbreviate off the three ending zeros. So that's what you see here is 80 million cash, 15 million delinquent tax receivable, 12 million as a reserve, so on and so forth. Further over to the right, you'll see that we have stuff in purple here. This is our budgeted information for the current year. So these are our budget accounts in purple. And then we have our quote-unquote income statement accounts, our revenue from taxes, from the state aid, yes, fees and licenses, service revenue, and then we have expenditures, not expenses, general service expenditure, maintenance expenditure, supplies, capital outlays, encumbrances, proceeds from this sale, and then transfer out to our debt service fund. We will see how all these play out, but just realize that these are essentially, we're kind of like a cash basis type of accounting organization when we're talking about the government. So we're not going to capitalize supplies. We're not going to capitalize any equipment that we buy. We're just going to simply call it an expenditure. So over to the far left, you're going to see over here that I have some information that kind of breaks out what's going on. I'm going to record journal entries as we've seen before in class in the white columns here. The stuff that's in brown or any other color, that's just FYI. These are my notes that I like to keep track of. So as we kind of go through this, just realize what's going on, why I use different rows and cells here. So let's talk about the first example here where we say, here is our balance sheet information. And we come down, we find out some more information about what the budget says in terms of total estimated revenues and estimated appropriations / expenditures. What does all that stuff mean? Well, it's essentially the budget that's been passed, and we need to enter that information into our ledger account so that we can compare what actually happened versus this budgeted information. So first thing is first, we're going to start off by recording total estimated revenues 240 as a debit. Estimated revenues 240. Estimated other financing sources 7 million. They tell us that up here. Appropriations, estimated financing uses. They give us that information up above here. How do we record this? Well, I'm going to show it here in the general ledger. And let me go ahead and freeze the panes here so we don't lose track of where we're at here. Freeze panes. And now let's go across. Excuse me. Don't want to get that. Let's go back up the top here. Freeze panes. Okay. So those are our balances. The first journal entry says, hey, we're going to do a budgeted journal entry. And granted, they tell us that there is 240,000 total estimated revenues and 218 total estimated expenditures. So debit 240, and then minus 218. Okay. What else did they give us? These other incidental things are going on. So other financing sources, 7 million and the 28 million. So 7, which we expect to get from selling a piece of equipment, and we're going to transfer out 28 million to the debt service fund. What is all that really coming down to? How did we come up with those numbers? So up above, I say, well, let me input what I've got over here, the 190, the 30, the 8. These are the specific types of sources where we're getting our revenues. So over here, I'm going to put down, I'm going to move this sucker over here a little bit so you can see what's going on. Estimated property taxes levied, 190. Well, actually, that's not really the case because there is 200 million levied, but 5% of that is deemed uncollectible. So that's interesting. Minus 5% times that. Okay, that's the 190 they're talking about there. That will become important for us later to keep track of. Sometimes they like to net things together, and it causes some frustration. State aid, 30. Fees, licenses, 8 million, and then 12 million services that we charge. Over in the appropriations, we have general services that we're going to pay for. 80. We got 14 for maintenance, 18 for supplies. We're just going to expense supplies. We're not going to capitalize them. And we expect to spend 6 million for new equipment. Going to expense those as well. There, the 7,000 they see here is for proceeds from selling property, so that will be an inflow, and there will definitely be a transfer out of 28 million for the debt service fund. So over here I have, excuse me, what I've done is I've just basically given more information about the context behind these numbers. And you don't have to do this, but I like to, I'm going to give you a template where this stuff is automatically grouped. So all you have to do is just click that button and shrink that information down. You don't have to worry about having that sucker stick out there. Now notice when we look at this journal entry here, down to the bottom right, the sum is debit heavy by 1,000. And over in the check column here, you see I've got these hashtags. Well, that basically means that there's some sort of weird imbalance going on here. So what do I have to do to make that balance? Well, let's go back to the journal entry really quick. We can see down here that any type of over or under is going to go to the fund balance unassigned account. This is like the equity account, an unassigned account. It's like kind of like our retained earnings. So we're going to have essentially a surplus in this case. We're going to have excess revenues over expenditures of about $1 million. So I need to include over in the fund balance unassigned this extra credit of $1 million here. So I'll put that sucker down. Is that budgeted? Is that how that came about? Yes. A lot of the times, some of these journal entries require us to use a plug figure, a plug account, to put in a debit or credit to make the journal entry balance. And oftentimes, it's the fund balance unassigned that is used as that sort of plug figure when it comes to, especially for budgetary reasons. We'll see more about that later. For right now, we're just going to say, hey, look, we anticipate a $1 million, in this case, surplus. If it was a debit, it would be a deficit. Debit, deficit, kind of sound like the same thing here. So there's our journal entry. There's the details about the journal entry, and we can go ahead and collapse that sucker down. We don't need to look at that anymore for right now. That's the first journal entry. We haven't really had any activity yet, just recorded the budget. So let's move on down to transaction number 2, which you see right here. Over here on the in the column C, you see how I put down the T2.0, T3.0, right? These aren't like Terminator logos here. These are just kind of keep track of where we're at. Taxes levied, transaction number 2.0. They're telling us that we have sent out to all of our tax people who owe us taxes, a bill for taxes receivable. So we sent that out. We've levied 200 million of those taxes, and we're going to go ahead and acknowledge that 10 million of that we might not collect. So total net tax revenue is 190. And that's net tax revenue. It's gross tax of 200 million minus 10 of what we would consider normally bad debt expense. But we just net it all into the tax revenue account. So let's go up here. Tax receivable current. So these are current year 2019 estimated amounts that people owe us. So 200 million. And then we have the estimated amount that we might not collect. Over in the far right, we're going to actually record in tax revenue the net of those. $190. And again, it's 190 is the net tax revenue we're recording. And I put a little note in there to sort of say, hey, this sucker is a net of. We have gross revenue and bad debt expense. In the brown area below, I'm actually going to write that sucker in. I'm going to say it's gross revenue of 200 million, net of what would ordinarily be bad debt expense, $10 million. That is the reason why we have 190. It's just a piece of information to make sure that I know how that number came about. That is transaction number 2. Let's look at transaction number 3. The county received 30 million in state aid. Okay, cash, state aid revenues. Cool. Let's plug that sucker in. I love getting cash. debit, especially from the government. Let's see here. Cash, we received $30 million. So go ahead and plug that in under cash. And then all the way over the far right column, go over to your orange accounts, state aid revenue. That's your credit of $30 million right there. Done. That's pretty straightforward. This is where it gets a little bit weird. We're collecting, last year we had delinquent taxes. And then this year we actually collected on some of those. So how much did we collect in delinquent taxes? $4 million. Let's take a look back at what this is all about, how this came about. Initially, when we levy taxes, we record them as tax receivable current. We collect those during the year, but any amounts that are left over at the end of the year, we transfer them from the tax receivable current into the tax receivable delinquent. And what we do is we bring over the gross amount that's left over in the tax receivable, and we put it, boom, right into tax delinquent. The allowance balance, we get rid of that as well, but we may have to do some adjustments to this allowance for the delinquency. So what do we do if we collect on some of these delinquent taxes? Well, first of all, let's take a look and see how much we actually expected to collect from these delinquent taxpayers. The net of these is $3 million. I expected to collect only $3 million in delinquent taxes. How much did I actually collect? $4 million. So let me go ahead and plug that sucker in there. $4 million, cash, remove $4 million with a credit from the delinquent taxes. Okay, that's interesting. But now look down below at the balances in those accounts. I have now remaining tax receivable delinquent, 11 million, and I'm going to reserve 12 million of that? That doesn't make sense, right? So clearly I need to adjust this allowance account. How am I going to do that? Well, the book says, after you record the cash, take the remainder of the 2018 delinquent taxes and reclassify them as tax liens receivable and fully reserve them. So we're going to take them away from the tax receivable delinquent account and put them into the tax liens receivable account. That's step one. So let's do that over here. The current balance is 11 million. Let's get rid of that with a credit. And then over in the tax lien receivable, plug that in as a debit. As a debit, 11 million. Boom. That part is taken care of. That makes sense. Then they come down here and they say, then debit the allowance account, the delinquent allowance account for the 12 million that's currently in there. All right, fair enough. Minus this. That sets both accounts to 0. Shouldn't I come over to the allowance for tax liens receivable and just transfer that whole balance over there? Well, no, not exactly, because first and foremost, the net of this is a net credit balance, so that doesn't make sense. What should be the net collected amount that we expect to collect from these tax liens? Well, they tell us in the information above that the tax liens receivable should be fully reserved, meaning that we don't expect to collect any of this 11 million. So the fact that I have 12 million here means I've over-reserved. I should only have 11 million as the allowance to completely offset the 11 million of the tax lien receivable. So how do I make this credit go from 12 to 11? I need a $1,000 debit. And when I do that, I'm going to see here that, let me adjust my sums here a little bit, that the net of those is now 0. I initially expected to collect 3 million. I got 4. How much of the remaining 11 million do I expect to collect? None of it. So I'm first going to transfer everything over from the tax receivable delinquent to the tax lien receivable. Then I'm going to adjust the allowance account so that way the net 11 million credit completely offsets or reserves against the receivable. I didn't even really expect to collect that much to begin with, so it's okay to say I don't really expect to collect the 11 million here. It's a lot of money. Let's not worry about that. But here's the problem here. This journal entry balance, this row balances, where's the credit I need to offset this? Well, guess where that goes? over here into the tax revenue column. I'm going to credit tax revenue as they show you here in this journal entry, but they're sort of netting everything together here in this journal entry. What I'm saying here is this. Last year, when I recorded my tax revenue last year, I reduced tax revenue. I debited tax revenue for the bad tax expense, or the bad debt expense. So did I over-reserve? Did I overestimate the deadbeats? Yes. How much did I overestimate the deadbeats? By $1 million. So this credit here to tax revenue, that's not new tax revenue. That's essentially just a plug figure we use to say, hey, we had over-reserved last year. We're backing out $1 million of that and recognizing it as revenue in the current period. And when I do that, then I have a row that balances. And let me adjust my overall balances here to include that other row. You'll see I like to use the sum function quite a bit here. So overall, what's happened, I've removed everything from the tax receivable delinquent column, including the allowance, and I've transferred it over to the tax lien receivable. Okay, now there's a lien against people's property, but I don't expect to collect any of that. So the $11 million has been fully reserved. I had to make an adjustment to get to that. I had to make an adjustment of that $12 million I carried over down to the $11 million as a reserve, and that simply meant that, hey, last year I had too high of an estimated delinquent estimated allowance. So I'm better off in this case. I've actually had positive news. I'm just simply recording that positive news as part of the current year tax revenue. So now I've officially taken care of that awkward looking journal entry 4. It takes some time to practice this to really get what's going on, but just realize that what we have here is sort of like a time intertemporal kind of confusion. There's stuff that happened last year that we're reversing out this year. Transaction 5 is a little bit more straightforward. We're simply saying, hey, we need to take money out of this fund and put it into the debt service fund. So let's go to transaction 5 down here, and let's take out $28 million. And we're going to put that to where? The debt service fund. But it's not going to be, it's essentially going to be treated like an expenditure or an expense. So there's the $28 million right there. Now I put like some notes in orange down here because we're only looking right now at one particular fund. But imagine what the accountants at the debt service fund would actually do on their side. They would show cash received of $28 million. And they would show a transfer in of $28 million on their books as well. So that for them, they would have their own sort of account over here. This is a transfer out for us, but imagine they have a column transfer in that looks like a revenue number. That's where they would show transfers in the debt service fund. So I'm just simply putting that down there to say, hey, look, FYI, the debt service fund is doing accounting of their own. Oops, excuse me. There we go. But that's just for my own edification. I'm not doing the accounting of the debt service fund. I'm just making a note that they should receive $28 million and record it as such. Proceeds from the sale of property. That's transaction number 6 down below here. So I'm going to get rid of old equipment, sell it for proceeds of $7.3 million. And I'm going to turn around and buy new equipment at $5.9 million. So let's go ahead and plug those in. First things first, I got cash proceeds. That was, if you recall, $7 million was what we budgeted. 7.3 are the proceeds we actually got. So we got a little bit more. That's just something worth noting. So we got 7.3 million. Put that in my cash column. I'm going to go all the way over to transfers out, proceeds from sale. There is where I show my proceeds as a credit. Kind of like a gain, if you will, because you have to keep in mind that we don't record property, plant, and equipment like most for-profit companies do. We expense that, or we call it an expenditure. So if we get proceeds from the sale of property, that's essentially a pure cash inflow. So we treat it as such with a credit of 7.3. Well, what about buying new equipment? What happens there? Let's go back over to cash. We need to credit cash for the new equipment, 5.9, and debit not an expense account, but it's an expenditure called capital outlay. We're not debiting an asset. We're not going to keep this stuff as fixed assets on our books. We're just going to essentially call it an expenditure. So we'll get rid of 5.9 million and then go all the way over to the expenditures, capital outlay, 5.9 million. Call it an expense if you want to, but essentially it's a modified accrual basis accounting. We're not keeping track of certain assets. We're just going to essentially expense them as we pay for them. Cash that comes in is purely cash revenue to us. And then we're just going to move on from there. So what's our next journal entry? Well, let's take a look over here. We've got transaction number 7. So Ranford Company is following GAAP budgetary basis for the year-end encumbrances. Encumbrances outstanding at the end of 2018, beginning of 2019, beginning of this year, were $2 million. So that's what we see up at the very, very top when we look at the balances all the way over in our quote-unquote equity accounts, our fund balances. That $2 million right there is essentially what we had reserved, set aside in terms of resources to pay for something. Now that payment never actually happened in 2018. So we carry that encumbrance over because we eventually will pay for it if we've ordered for it. So what they're saying here is that the encumbrances outstanding at the end of 2018 were for general services. So we expected to pay money for general services of $2 million. The bill we actually received after they were completed in 2019 was $1.8 million in cash. So what do we do to get rid of this $2 million and actually record that there was $1.8 million in true expenditures? Well, you can have to take a step-by-step approach. First, we need to get rid of the unassigned portion of that encumbrance, the $2 million. So this is going to look weird because it's going to look like we're recording an encumbrance and then we're going to take it immediately out. So first things first, debit encumbrances and get rid of the $2 million in the unassigned fund balance. So let's go to the unassigned, the unassigned fund balance here. So when we do this, we'll start with the unassigned, come down to 2018 encumbrance restored. So we've got this debit to encumbrances, which ordinarily we use in the current year when we actually order something but haven't received it. So let's just go ahead and follow along with what they tell us to do. There's the $2 million debit, and we're going to go all the way over to the unassigned column and put in the credit there. What do we do next? Well, now it essentially looks like we're going to reverse out what was the previous balance at the beginning of the year. So let's debit away the assigned fund balance, $2 million. So go to this column, the fund balance assigned, and just get rid of that $2 million with a debit there. We're reversing out what we had before. And in doing so, what's the credit we use for that particular transaction? Well, it's essentially just netting out the encumbrances. It seems kind of tedious, but the idea is you've got several moving pieces here in and out. So let's take a look at the explanation they give us. The first one is to restore the encumbrances carried over from 2018. So yes, we're going to say, oh, hey, last year's encumbrances, we zeroed those out and put them to the assigned fund balance. Now we're simply saying is, hey, those encumbrances, remember last year? Let's actually record them this year because this is the year we actually pay for them. So we record an encumbrance, meaning, hey, we're recording an anticipated expenditure of $2 million. Well, that anticipated expenditure was last year's. We just carried it over into this year. But now we're saying, hold on, but we've paid for that. We've received those services, right? So let's go ahead and credit the encumbrance to say we no longer need the $2 million set aside. So we put $2 million in, immediately take $2 million out. It's kind of quick. You don't even really notice it, but the encumbrance is net to zero. Where does the debit go? The fund balance that was assigned, and that was to reverse the encumbrances from last year's that we essentially brought over into this year. It seems kind of complicated, but you'll see how we use encumbrances down below. Go back and review this and make sure that you understand why this process is necessary. So quick in and out to the encumbrances. We transfer things from, we're transferring from the assigned fund balance to the unassigned fund balance. But we're not quite done yet. We actually spent money for these services. So what we're going to do is credit cash for how much. The actual amount was 1.8 million. And we're going to debit general services expenditure for that same amount. So there's my debit. That was the true amount. The encumbrance is just there to sort of say if there's a time lag between when we send a purchase order and when we actually receive the goods or services, that's the encumbrance account. That's why we use that. So all this stuff was just last year's. We're just kind of reversing out and making sure everything is trued up. So once that's the case, once we do that, now everything is now essentially we can say that the fund balance that's unassigned, this 86 million, that's what the unassigned balance should have been, essentially. That 2 million should have been netted into this fund balance unassigned at the beginning of the year if we had actually spent the money that we encumbered. But when we have an encumbrance that has not been followed through, we put it into the assigned column. And then, once it's actually been consumed, then we move it over to the unassigned column. You'll see how that works out in the closing entries down below. Let's move on to the next journal entry, T.8. Revenues of 21.3 million were received as follows: 9.5 million from fees and licenses, 11.8 from charges for services. Okay, total of 21.3, but we want to use a separate accounts. Fee revenues, 9.5. So let's do that first. Fee revenues, 9.5. There's my credit. What's the other portion? 11.8 to service revenues. Service revenues, 11,800. There's my two credits. What do those sum up to? $21.3 million. There's my debit, 21.3 million. You can just type yours in. I'm using formulas. You don't have to use formulas to type in this information. That's the journal entry that we see right here. So I've recorded that. That's nice. Supplies. Supplies were ordered. We haven't received the supplies yet, so we haven't paid for them, and we don't owe any money. We just sent in a purchase order. So think about this now. It's actually taking a step further ahead than what most for-profit companies do. Usually a for-profit corporation will record in accounts payable and supplies when they're received. Here, all we've done is to send in a purchase order. But when we do that, we need to acknowledge at that point in time that some of our resources, some of the resources of the government have been locked away or reserved. So they call it to record supplies order. I like to say it's a reserve for supplies order. We're reserving some resources for these supplies. So the encumbrance account, we haven't expended anything. We're just going to say, hey, look, we expect to pay 18 million, have 18 million in expenditures. So let's go ahead and debit 18 million. It's not an expenditure yet, but it will be when we actually get the bill and get the stuff. Where does the credit go to? The credit's not going to go to cash because we haven't paid for anything. The credit's not going to go to accounts payable because we haven't received anything. So where's the credit go to? Well, you guessed it. It goes to, in this case, the fund balance assigned. Because the fund balance assigned is the fund balances together represent the equity or the resources, the net resources of the government. If we've actually set aside if we need to reserve some of those resources for a committed purchase, we're going to put in the credit to the assigned portion of the fund balance. So we're simply saying here that we've committed to paying 18 million potentially generally 18 million is pretty close number in this case because we have a purchase order. We're going to pay in the future 18 million. So let's set aside, let's earmark, if you will, 18 million and put that into the assigned portion of the fund balance. The unassigned is free to spend money on, but we only really use that at the beginning and end of the year. So just realize what the two differences are for the assigned and the unassigned portion there. We're reserving money, we're reserving resources to buy these supplies. Now, let's move on to transaction 10. We'll get to the other supplies later. Cash expenditures were $40.3 million for general services. Orders were issued for maintenance services of 14 and for general services of 135. Okay, so we have to be very careful here because if we submit an order for stuff that we want, that we're going to consume, have we actually paid for anything yet? No. Submitting a purchase order or any type of order for having goods or services signals that we have an encumbrance. So just as we saw before with the encumbrance of the supplies, let's jump down into the encumbrances for the maintenance and for the general services, the second part down here. The total amount is 149, but we know it's 14 for general service, 14 for maintenance, 135 for general. So let me go over to the encumbrances. 14 general, 135, 14 for maintenance, 135 for general. Total amount encumbered, 149. That's the debit portion of this transaction. And you can see it right there. Debit encumbrances, 149. Is it an expenditure yet? No. Encumbrance means that we will have an expenditure for these amounts once we've actually received these services. So if we've sent in an order, we're encumbering or reserving some of the funds that we have in the company or in the government. So go all the way over to fund balance assigned, that column, and say, hey, guess what? We have to credit the fund balance assigned for that same total amount. So it seems like the idea here is that we've committed to making cash outlays in the future. The fund balance assigned is keeping track of those so that way we don't overspend resources that we do not have. Right now, we have 86 million in unassigned resources, but we're committing some of those into this column, the assigned column, to let us know that, hey, we've got some other stuff coming our way, so we just need to be aware of what truly is available that's available to be spent and what is not, what has been encumbered. Then let's talk about the actual services we spent for general services. Cash, 40.3 million. So, cash paid for general services, 43 million, 40.3 million. There's my credit. Where's my debit? It's over in the expenditures column. General services expenditure. There it is, 40.3 million general service expenditures. So that gets us through transaction number 10 here. Now let's look at transaction number 11. Supplies that we ordered in transaction 9 have been received, and the total amount we got was 18 million. So fortunately, we don't have any shortfall or overage in this case. We actually got 18 million in supplies. What are we going to do in this case? Well, once we get them, we're just going to go ahead and pay them in cash. So we won't have to worry about dealing with an account payable in this case. So we're using the purchases method here of accounting, and that means any unused inventory balances are insignificant. We're not going to worry about them. We're just going to fully expend everything. We're not going to set aside things as an asset. So let's go down to this row. Let me go ahead and make that sucker go away. So first thing is first. We got supplies. Question 1, did we actually encumber those? Yes, we did. So we have to reverse the encumbrance that we did before. So go all the way over to encumbrances. Remember that 18 from above? Right there? We are now going to get rid of it. Why? Because we have received those. So we reverse that sucker out, and then where do we go? Where was the other 18? In the assigned column. So fund balance assigned is going to be the 18 million debit. So what have we essentially done with this row? This row, T9.0, is essentially just reversing out what we did in the row number 41 is reversing out what we did in row number 36. So I'm simply saying here, this negative T9.0, I'm just reversing it out. Why? Because I got the supplies now, but I'm not done. I'm actually going to, now that I have the supplies, what do? Well, I'm not going to record supplies as an asset. I'm just going to expend them. So I'm going to credit cash for 18 million, send the check off, not record an asset for supplies, but just go ahead and expend all of them. So supplies expenditure, that's going to be my debit. There it is. Debit 18. So hopefully you see why the whole encumbrance balance, why we use that. If we have any encumbrances that we don't actually receive or pay for, those will get carried over in the following year. But the encumbrances are like in and out, in and out, in and out most of the time during the year. That's transaction 11. Reverse out the encumbrance, then record the actual payment for the supplies as an expenditure. Supplies expenditures, not supplies asset. Number 12, current taxes 183 were collected. So tax receivable current needs to go down by what we actually collected, 183, and we got cash for that. That's good news. So tax collected, debit 183 million for cash. Under the current tax column, put that credit down there. Now, we'll have to do some adjustment to the allowance account later down the road, but realize that currently as it stands, 17 million hasn't been collected for the current year assessment. Is 10 million of that really what we don't expect to collect? We may need to make an adjustment here, but for right now, that's the journal entry for 12. Next thing, invoices for goods and services ordered in transaction 10 have been received. Maintenance 14 million, general services 136 million. So we'll get a little bit more on the services side. The total amount that was paid was 152 on its accounts payable. So in this case, what we're doing is they're telling us first we need to reverse out what we had as an encumbrance. So notice how the encumbrance was a debit balance of 149. Now we're going to credit the encumbrance to get rid of it and remove it out of the fund balance assigned column. So reversing out what we did in the previous, and that's why I put this in green, so that way we kind of keep track of which encumbrances are for what. Reverse that one out, and then also reverse out the assigned fund balance assigned portion. That's always step one. Just realize that. Now, just to keep track of what's going on, I didn't give notes up above, but I think it's just kind of worth noting down below that the encumbrances were for what? Scroll back up here. It was 14 for general services and 135 for, well, so 114 for maintenance and 135 for general services. So let me expand that. Recall from up above when I had that entry in the brown column right there. All I'm simply saying is that 149 we initially encumbered was comprised of those balances. Now I'm simply saying is I'm getting rid of that in its entirety. Granted, I actually received 136,000 in general services. But right now, the step one is simply to reverse out whatever the encumbrance balance was in total. Worry about the rest later. The next portion of this transaction says what? Once we get rid of the encumbrance, now we actually have to acknowledge that we either paid for this or recorded in accounts payable. So they don't quite give us the information clearly that we essentially incurred this on account. So let's just go ahead and record that as an account payable. Total amount we received, 14,136. Okay? That was maintenance expenditure, general services expenditure. We'll go ahead and credit accounts payable rather than cash. So accounts payable, 150. And then what was the actual amount of expenditures? Maintenance, 14. And the other one was the general services for 136. The net of those is 150. Where's the credit? To accounts payable. I even put a little note in there to say, hey, by the way, that is obviously 150 is higher than the 149 that we initially reserved. So why is an extra 1,000 higher? Because we actually paid 136 in general services, not 135. Just made a little note there, just remind myself. There we go. Well, we're thinking. Okay. Now they say as part of this journal entry that the county turned around and paid $152,000 on its accounts payable. So down below, Mississippi State, part of the AP was paid of $152 million, and that's going to be paid in cash. So go over to the cash column. Why didn't we pay off the full balance? Who knows? But we just want to make sure that we put that as an example in this comprehensive illustration. Transaction number 14. Goods to be used in providing general services were ordered. When you hear the word ordered, think encumbrance. Goods to be used in providing general services were ordered late in December for $1.3 million, but were not received in 2019. So I'm going to give you the heads up about this. Okay, this is similar to what we saw in the earlier example. Recall that we started with $2 million in the assigned fund balance. And then we had to turn around and do this weird sort of, let's go ahead and recognize the encumbrance for $2 million, credit on the unassigned, debit the unassigned, credit the encumbrance. Remember that from row 31 and 32? Well, this is basically something similar of what's going on in 2019. We're going to encumber an amount, and it will be $2 million. In this case, it's $1.3 million. So down below, where are we at here? We're going to set aside, we're going to make a reserve for goods that have been ordered. So in this case, I will show this as a normal encumbrance. 1300. 1.3 million. And as I usually do with encumbrances, and you can look at previous examples where we did this, that process requires me to credit the assigned fund balance. So there it goes. Now, if this expenditure does not get realized, if we don't get those goods in 2019, then notice how the balance of 1.3 in the assigned fund balance will get carried over into 2020. This right here is what happened last year. We had $2 million of an encumbrance last year that got carried over and was realized in 2019. So they're giving us a heads up here saying, hey, we've made an order for goods in 2019, but we won't get them until next year. So that fund balance will carry over into next year as a fund balance that has been assigned. So that's where we do a debit to encumbrance. Legitimately, that happened this year. Credit the fund balance assigned. Fair enough. And by the way, that won't be paid out until next year. Transaction 15, cash of $10 million was received from the Special Revenue Fund as a repayment of a loan made in 2018. Cool. So we can give money to our friends in a different fund. They pay us back. It's all good. Here we're just simply saying that we got the cash. So cash received from the Special Revenue Fund was $10 million. And we can get rid of that due from Service Revenue Fund. So we're getting rid of that balance, the $10 million. No more amount owed to us there. All right. Now we're at the end of the year, and we've determined that taxes uncollected, current year tax receivable uncollected, were classified as delinquent. What does that require us to do? Well, let's take a look and see what amount is still outstanding. $17 million as tax receivable current. We need to get rid of that. Okay. Now I'm going to sort of do what we saw before, but I'm going to put it in the brown area, just so that way it's going to be clear about what are the moving pieces here. So we're going to get rid of the 17 million tax receivable current, and so there's the credit, tax receivable current, 17 million. Rather than put that in right away, let me just make a little note about that. I'm going to get rid of this, and I'm going to transfer it over into the delinquent column. So it went from one side to the other. Now, when I do that, it makes sense to say, well, let's go ahead and transfer the balance in the allowance for tax receivable current to allowance for tax receivable delinquent. So let's get rid of that and just transfer it straight over here. So when we do that, we're simply saying that the net 7 million that we initially were going to expect to collect in the current year is now delinquent. We might collect it in the following year. So when we transfer this over, realize that at this stage of the transaction, we're still saying that we expect to collect 7 million, but it's going to be in the next year. So I'm going to do something that's kind of an excessive step here. I'm going to say, all right, if this stuff is delinquent, right, what would we need to include as part of this credit to the allowance account to make it fully reserved? Because recall from earlier, when we had the lien, we took delinquent tax receivables and we put them over into the tax lien receivable. We said, hey, let's go ahead and reserve for the full amount outstanding. When I'm moving from tax receivable current to tax receivable delinquent, delinquency doesn't really has sort of a negative connotation to that. But let's just say that these things are now delinquent down below. What would it take for me to reserve the full 17 million, just so that way I can kind of say, I don't really expect to collect anything? Well, I would need an extra credit of 7 million. If I do that, then the net becomes 0. I could say at this point that I tried my hardest to collect on that 17 million all year long, and I got nowhere. Does it make sense to increase or adjust the allowance so that it's fully reserved? Sure, I can make an argument for that. And if I do, what I would say is the amount of tax revenue for the current year was too high. I need to reduce my tax revenue because I, at this stage, think that maybe I didn't reserve enough. 5% wasn't really high enough, right? I had 17 million still left over. I tried to collect that. So potentially I didn't reserve enough when I initially recorded this up above at the 190 million level. So potentially that should have been brought down lower. I'm only realizing this a year later, so let me just go ahead and bring down tax revenue by $7 million in this case and set my reserve so that it completely offsets the full 17 million in tax receivable delinquent. That seems reasonable. It's a bit excessive because in reality, a delinquent tax receivable is not nasty. It's not as bad as it seems. Delinquency just simply means that if we're going into a new year, any carryovers of a receivable from the prior year need to be called something different. So I don't want you to look at delinquency and think, oh my gosh, it's really bad, right? No, not really. It just means that, hey, we're going into a new year. Let's shift things over into a new type of an account. That's what's going on here. The question we really need to ask ourselves is, do we really expect to collect 0 from the 17 million? Or maybe the 7 million is still reasonable? Well, think about this. Let's go ahead and set it to 0 and then go back to the facts and look to see whether or not that is reasonable. Should we collect 0, or is there some amount higher that we expect to collect? And they say right here, 2 million of these now delinquent accounts receivables of these uncollected amounts will be collected in 2020. Okay, so this, we need to essentially bump up the net of 0 here. We need to bring it up to a net of 2 million. So I'm going to back out 2 million right here. And so what you can kind of see here is that the net allowance that I've recorded with these 3 lines here is 15 million. I've done it in different pieces here, but I think the way that they show it in just this one journal entry is a bit confusing, because they simply say, oh, just credit the allowance for delinquent receivables to 15. I'm simply showing you that it's kind of comprised of a couple things. Initially transferring over the 10 million, setting it up high enough to completely offset the 17 million, but then saying, let's be reasonable and put in 2 million net. Overall, the net delinquent accounts receivable that we expect to collect, $2 million. That's the net of those. So where does this 2 million debit get offset from? Tax revenue. This is the story. This is the perspective I'm giving you. It's kind of like going too aggressive, then backing off to be more reasonable. When we do that, what happens to this overall journal entry? Well, 17 million is going to be credited to the tax receivable current. Tax receivable current, credit 17 million. We're also going to credit, let's just do this guy. We're also going to, oh, that doesn't do enough, equals sum. We're also going to credit the allowance account for 15 million. There it is, allowance for uncollectible taxes, delinquent, 15 million. So those are those 2 credits of the journal entry. What were the debits? Well, 10 million was taken out of allowance for tax receivable current. Where is that? Allowance for tax receivable current, 10 million debit. We also had a debit to the tax receivable delinquent account, 17 million debit. Where is that? Tax receivable delinquent, 17 million. Where's the other portion? Tax revenues. 5 million debit. What? Yep, tax revenues, 5 million debit. But you see, when you look at that journal entry, in my opinion, it's kind of confusing. You don't really know where they're coming up with some of these numbers, but you have to kind of build a story. And that's why I say, when you look back at this, realize, yes, we're transferring balances over from current to delinquent. Then we're asking ourselves, do we really expect to collect that whole amount? Let's just say we're not going to collect any of it. And then back out, and we'll probably collect some of it. That's the story I'm giving you here, just kind of give you more context of what's going on. If that helps you, great. If it doesn't, I'm happy to talk more about it in class. All right, so that's transaction 16. Boom. Okay, so now we've got ourselves some nice little balances here. Go all the way across. All this stuff in yellow should be appropriate, should be correct. And we can double check this by looking at, guess what? They provide us a trial balance. Cash should be 89.6 million. Hey, look, 89.6 million. The tax receivable delinquent should be 17, and allowance should be 15. Tax receivable delinquent, 17. Go all the way down to allowance for tax receivable delinquent, 15. Boom, right there. 11, 11, 11, 11. So far, so good. AP, 6 million. Fund balance unassigned. Fund balance assigned. Where are those? There's the 6 million accounts payable, and then there's the 86 and the 1.3. Cool. What about the budgeted accounts? Those accounts are in there. There's the 240, there's the 7. 218 and 28, those still right there. Nothing's changed there. Actual revenues during the year, 186, 30, 9.5, 11.8, and there's that 7.3 right there for those proceeds from the capital assets, sale of the capital assets. What about all the debits? 178, 1.3, where is that? There's the 1.3. There's the 178, 100. 14, 18, 5.9. 14, 18, 5.9. And then transfers out 28. Boom, we got everything. So let's go into, this is just on the info tab here. What I've done here is sort of highlighted what are the balance sheet accounts, what are the quote unquote income statement accounts, and what are the budgeted accounts. And so everything we've done is appropriately in our general ledger. We got the balances tied out. What do we do now? Well, we're going to do some closing journal entries. And closing journal entries, basically, as you recall from financial accounting, require us to get rid of all the quote unquote income statement accounts. Those balances in the income statement accounts need to be set to 0 for the start of next year. Well, what were our quote unquote income statement accounts? Well, we had the revenues, state aid revenues, fee and license revenues, etc. We need to, those are all credit balances up above. Here they are. We need to debit those away. So down below, how do we get rid of those? Close money sources. That's the row I have right here. So close the money sources. I've got this 186. I'm going to debit that away. Debit the state aid, fees, revenue, and service revenue. Get rid of all those. And oh, by the way, there was something else I recall, 7.3. Okay. Now, when I close those out, do those go to retained earnings? No, there are no retained earnings. Okay. What we have done initially was we set up if you recall, budgeted balances for those. So the estimated revenues and the estimated other financing sources, recall that we initially put those suckers in as debits. Well, down below, what we're going to do now is we are going to, when we debit away the actual revenue items, we're going to credit away all the budgeted items. And so when we do that, we're going to see, do we have a net plug figure that's a debit or a credit? In this case, you can see when we close out the accounts, we have a debit to the fund balance unassigned of 2.4. Is that good? Is that bad? We'll take a look at that in a second. For right now, let's go back to this and continue on. We need to get rid of this 2.4. We need to get rid of this 7. And so when we net those across, we're credit heavy by 2.4 million down here. So we're going to use the unassigned fund balance. That fund balance unassigned, like I said, told you before, is kind of like our retained earnings. Okay, these are the unrestricted resources of this government unit. So in this case, we're simply saying, hey, this is the net amount relative to what we expected from the budget. So it's a debit. Kind of seems like it's not that good, but hold on, let's not try to interpret this yet. Let's go to the money. Let's see, the money. We close the money sources. Excuse me here. Let me make sure I get the right rows in this case. Oh, I need to move that. My bad. I think I set this up to be. Let me move these guys down here. One row. Sort of separating these guys out into different rows. My apologies here. So this is the there it is. So I'm just separating these out into 3 lines here. Close the money sources, close the budgeted money sources, the net increase, decrease from money sources, 2.4. Next line down is we're going to be closing the money uses in this case. So if we go across, what were the money uses? What was that 178? All these other guys. And the transfer out. So there's all of our money uses. So we're going to close money uses. And then guess what we're going to do next? Close budgeted money uses. So go over to the budgeted column. get rid of these guys. And what's the net go to? It's going to go to the fund balance unassigned. So, use my quick sum formula here. Saves me some time. Boom. 700 credit is what I'm going to record for the fund balance unassigned. And we can look at the transaction here, we see, oh, there it is. We debited away our appropriations and our estimated other financing uses. So there's our debits right there. We credit away all the expenditures, and we have a net credit for 700. So we're good to go. This is essentially the closing entry. The plug figures are going to the fund balance unassigned. And that helps determine for us also relatively how close were we from when we initially estimated our revenues and our expenditures. We can kind of see that we were off with the revenues by about 2.4 million, and we're off 700,000 on the expenditures. But are those good or bad? Okay. Down below, what we can do is we can create a balance sheet with what we have left over in this case. So down below, what I've done is essentially said, hey, look, need to move these guys down here a little bit. So let me check these sums. Equals, well, excuse me, let me actually record these in the white area now. Excuse me, equals this. Kind of got carried away here. Equals. And equals. Bear with me as I go through this really quickly. Sometimes my notes end up turning into the actual journal entry itself. Oh, Excel, you crack me up. Okay, that's the journal entry. I'm just putting everything into the white column just to sort of show what that net journal entry is there. So net 0, I've got everything, net 0. Just double checking. Now, okay. All my expenditure accounts and all my revenue accounts are now reset back to 0. My budgeted accounts have been reset back to 0. So everything from here over to the right is ready for next year. What am I left with here? Well, my fund balance unassigned is now 84.3. I have some encumbrances I'm carrying over from 2019 into 2020 of 1.3 million. 6 million in payables. I have some liens that I fully reserved for. I have mostly reserved for the delinquent tax receivables, and the rest is all cash. So these items you see here on this row should tie back to everything we see in this balance sheet right here. And they do. All the stuff we see here, we just saw in my general ledger. And we can take all the information of the closed accounts and put those into a quote-unquote income statement. It's not an income statement. It's a statement of revenues, expenditures, and changes in fund balance. Okay, so all those accounts we closed out to the fund balance unassigned. And again, as I talked about in class, realize that when we get down to it, the excess of revenues and other financing sources over expenditures and other financing uses, blah, 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 that's essentially what we would consider net income. So this 600 is like our net income. But then for governmental purposes, we kind of deviate from that and do kind of like a cash flow roll forward, where we say, well, what was beginning balances of the unassigned fund? So we have unassigned fund balance of 83, and there was the assigned fund balance of 2 million. So we started off the year with 85 million. Now we add 6, so we should have 85.6 as our fund balance. Do we have that? Let's go over to our fund balances here. Net those together, what do we get? 85.6. So we do. 85.6. Beginning of the year plus changes gets us to 85.6. So this row you see right here is basically just taking, I'm taking essentially all the absolute values of the existing balances on the balance sheet. This is my balance sheet right here, this row. Just call that your balance sheet. Total assets, 91.6. Total liabilities, fund balance, 91.6. We did all that. And let's see here. And then here's my income statement. Basically just going through and showing you all the balances for financial statement purposes. Balance sheet and the income statement accounts. Again, all absolute values. Those sum formulas are already in there. You don't need to do anything with those. What else do we have to worry about, though? We've done all these fun little balance sheet and income statement reports. What do we do now when we look back at the budget? Well, what we want to do is kind of go back and do a budget versus actual. And the budget is what we initially recorded in the general ledger on the previous page. So let me go back all the way to the top and reveal to you what we had shown before. All the way to the top. Let's go, Excel. Come on. All right. Estimated property taxes. Estimated blah, blah, blah. All this stuff in purple here. I'm basically taking all this information, this budgeted detail, and I'm putting it into the budgeted column. And then what I'm doing is I'm comparing it to the actual amounts that are received for property taxes, state aid, et cetera, et cetera. So all the stuff that we reported on the our quote-unquote income statement above, right here, I'm taking all this information and putting it into the actual column. So I can now go side by side, budget versus actual. The interpretation is rather intuitive, but we call the difference, whether depending on what it is, we call the difference either favorable or unfavorable. In this case, if I'm looking at the budgeted amount of property taxes of $190 million, I collected actually $186. So you can see that I'm fallen short about $4 million. So actual minus budget, $4 million negative. What is that? How do I interpret that? Well, as you can kind of see in this column here, we see that's an unfavorable difference. Why are we calling it unfavorable? Well, because we didn't get as much as we hoped for. So when you're looking at the revenue items, think about the actual as we want the actual to be equal to, if not higher than the actual budgeted. Below in the fees and licenses, we collected actually $9.5 million, which is higher than the $8 million we expected by 1.5. Is that a favorable or unfavorable difference? It's totally favorable. We collected more than we expected. So yay! What about expenditures? Well, this is a situation where we don't want to spend as much as we thought. So if I look at general services, I expected to pay $180 million, but I only ended up paying $178.1. That means I underpaid or I had expenditures below by $1.9 million. This is a situation where the actual is less than the expected, but that's okay. We want our actual expenditures to be less than our anticipated. So it looks like we saved ourselves some money. So realize when you're interpreting these favorable, unfavorable differences, you kind of have to take the context into consideration. Is it good or bad? Well, if you keep the formula the same all the way down and just title that column favorable and then parentheses unfavorable, you won't misinterpret anything. It should be fine. But as we go down this, one thing I want to mention is while we may desire to have favorable differences, from a political standpoint, that's not a good thing. Take the expenditures, for instance. We actually spent less than we anticipated. Guess what's going to happen probably for 2020? They'll budget an amount that's less in expenditures for next year. They tend to look at the actual expenditures and say, well, that must be what we should be budgeting for next year. So it's kind of one of those things where you might hear in a governmental office that which you don't spend, you either spend it or you lose it. So that's why towards the end of a fiscal year, if there's any amounts of expenditures in the budget that haven't been spent yet, you all of a sudden get a lot of people sending out purchase orders for things. So that way they can get their actual expenditures up to roughly about what the budgeted amount is. If they fall short of the budgeted amount, generally that means that they're going to cut away from the budget next year any amounts they did not spend. So people try to spend pretty close to, if not maybe a little bit over what the budget was, so they can maintain their level of expenditures going forward. In the case of revenues, this is one where I see kind of a lot of false manipulation or just general manipulation going on. If we fall short of our actuals, of our budget in this case, our actual falls short than the budget, a lot of people will be wondering, why is that the case? Who is going to be held accountable? Who did not do their job potentially? There could be a variety of reasons that explain why we didn't collect property taxes. A poor economic environment is usually the reason why our revenues are lower than our budget. But the question comes down to this. Should we lower for next year our anticipated revenue streams, given what we've had in the current year? Because you can see that total revenues have fallen short of budget by 2.7 million. Maybe we should lower our expectations for revenues. And in doing so, we may need to also lower our expenditures so the budget gets balanced. So these are the things that tend to get talked about the most in a board meeting, is the over-under. And when you're going through, you just want to make sure that you can understand what the differences mean, how to interpret them, and realize what the consequences are in that political discussion. So that's all I want to talk about for this comprehensive example. I know it's long. Hopefully you followed along with it. You filled in the spreadsheet. If you have any questions, please let me know.